Today, we're going to be talking about one of the most used techniques in all of option selling, the wheel strategy. It's an absolute must know strategy if you are serious about selling options and making that money. It's a simple but effective way to generate income utilizing both cash secured puts and covered calls. It's personally helped me manage over $1 million of options selling premium. But remember, I am not a financial advisor. I'm just a 42-year-old who retired last year at the age of 41 years old, sharing my journey with you. The wheel strategy is a very common and beloved approach for option sellers. It's simple but powerful, combining both cash secured puts and covered calls to generate income. If you're unfamiliar, let me break it down. A cash secured put is when you say, I'm willing to buy shares of a stock at a certain price called the strike price by a certain date called the expiration date. And you're securing the put with cash, hence the name cash secured put. A covered call is when you own shares of a stock and say, I'm willing to sell shares at a certain price called the strike price by a certain date called the expiration date, hence the name covering the call with your shares. And in each case, both cash secured puts and covered calls, every contract is 100 shares. With the wheel strategy, you're using both cash secured puts and covered calls, and it doesn't matter which direction you start in. You can begin with cash secured puts, and if you're assigned, meaning you have to buy the shares, you start selling covered calls. Or maybe you already own the shares or you get assigned the shares and immediately start selling covered calls. And if those calls get assigned, you sell your shares and then sell a cash secured put to potentially buy them out. Essentially, you're collecting premiums from selling against your shares and your cash collaterals, collecting income both ways, and that's why it's called the wheel strategy. It goes round and round like the wheels on the bus. For anybody to have kids, you guys know exactly what I'm talking about. To be clear, it does not matter if you start with a cash secured put and then sell a covered call, or start with a covered call and then sell a cash secured put. It's literally all the same. There's a couple of schools of thoughts on picking the strike price. Say you sell a SoFi cash secured put at a $14 strike and it get assigned, meaning you buy the shares at $14. Some people would then sell the covered calls at the same $14 strike. Others might sell at their cost basis, which is the strike price minus the cumulative premiums collected. That means all the premiums collected from your cash secured puts and from your covered calls is just a way to break even faster. I generally sell at the same strike price that I got assigned both ways. So if I buy shares at a $14 strike with a cash secured put, I'll then sell a covered call at a $14 strike, and vice versa. If I sell a $14 strike covered call and get assigned, I'll then go ahead and sell a $14 cash secured put. However, there are times when you can adjust for more profit. If you sell a covered call, say at a $100 strike for ABC stock, and your shares get assigned, but that next Monday, the share price might drop, you can then sell cash secured puts at a lower strike, say $95, to increase your profit. On the flip side, if you bought shares at $14 via cash secured put and it gets assigned on Friday, then by that Monday, the price jumps to $16. You can then sell a covered call at the higher strike price, like $15 or so, to boost your gains. There's no right or wrong way to do it. It evolves with the market conditions and depends on so many different variables. I want to talk to you about selling options in general. I'm about to explain why the wheel strategy is so great and who it's for, but before I move any further, I wanted to say when selling options, you cannot get scared if you're selling covered calls that your shares are going to be bought. And if selling cash secured puts, you cannot be scared that you have to buy shares. At the end of the day, the most seasoned veterans get assigned. But that's the beauty about options or selling options. When you get assigned either to sell your shares or to buy shares, it doesn't mean you lost your money. All it means is You made money one way or the other, but it's possible you just made a little bit less money on one end, and it's possible that you need to wait to make money on the other end. It's not like buying an option where if it doesn't work out, you get totally wiped out from all your money. The wheel strategy is particularly beneficial for income focused investors and those transitioning into options trading. Here's why it's a great fit. For income generators, they're collecting premiums for both puts and calls, giving you a consistent income stream. For passive income, it's an active approach to passive investing, letting you stack small but regular profits. And when you're transitioning into options, the wheel strategy is simple, making it perfect for a starting point for options newbies, which most of you are, but a lot of you, I'm getting a chance to speak to you, are starting to become more seasoned. It's a balanced approach which combines selling puts for income, then potential stock ownership to mix a passive and active investing. It has modest risk and a moderate risk strategy. Since it's secured by cash and shares, limiting your losses, the other side of buying options, which increases the maximum amount of losses that you can have. You don't need margin. You don't need to have a margin account, which keeps things straightforward. Long term growth, you can use the wheel strategy on stocks you expect to grow long term, earning income while potentially profiting from these gains. In a moment, I'll show you a perfect example using a $14 strike SoFi option that I personally own, both a cash secured put and a covered call, illustrating on the screen to bring this all to life. Before I do, click on the link up above. It's a $14 strike covered call and cash secured put position I have on SoFi to better understand before I share the screen. I'm about to share my screen with you and show you an example of the wheel strategy I've been using with the SoFi stock. But before I do, I wanted to say that today was the first day that I offered one on one coaching, and it was an absolute blast. My whole day was booked, and I have people booking for this Wednesday, next Sunday, and the following Sunday. If you want a one on one, I have a link which is going to be pinned to my comment section down below. And all you got to do is click on it and find an availability to schedule. It's $50 for a 45-minute Zoom style session where we could both share screens, not financial advice, purely entertainment and sharing my journey through some coaching. And later tonight at 6:55, we're going to have a live. I'm looking forward to seeing all of you. I'm not a financial advisor, and this isn't advice. Take a look at the screen. I want you to pay attention to this. I have a SoFi $14 strike covered call expiring on June 13th for these 13 contracts over here. If I go to an older date, you're going to see that I also have in April a $14 strike covered call for SoFi. And if you go a little bit lower, you're going to see that in March, I also sold a $14 covered call strike for SoFi. So you might ask yourself, well, Adam, why do you have covered calls for SoFi at a $14 strike for the last 3 months? And the answer is because I initiated a SoFi wheel strategy. Earlier in February and early March, I started selling cash secured puts at Guess It, a $14 strike for SoFi. I originally had like 480 contracts. 13 of the 480 contracts got assigned, while 467 of those contracts did not get assigned, which I'm consistently rolling. So, of the contracts that I initially opened, 13, a very small percentage, actually got assigned. Guess what I did? Instead of me worrying or panicking, the options that I can't manage or roll or didn't get there in time, all I do is initiate the wheel strategy, and I bought them at a $14 strike, and I am saying that now I am willing to sell them at the same exact $14 strike. It's not rocket science, it's super simple. Along the way, when I bought them for $14, remember, I collected a premium for the cash secured put. So my actual cost basis is not the $14 strike, it's the $14 strike minus the premium that I collected. And when I sell it for $14, I didn't actually sell it for $14. I actually sold it for $14. And you got to add the cumulative premium that I collected the entire time because I keep selling the same covered call every single month. Look at the screen. My $14 strike that I'm going to be selling for is actually $14.30 because I collected a 30 cents premium. And then I collected another 23 cents. So now I'm at $14.53. And I collected another 49 cents, let's say. So now I'm at $15.03. So by initiating a wheel strategy, not only did I get assigned and I have to sell the shares for the same strike price that I bought them, in reality, I didn't buy for $14. I bought for like $13.50. And I don't have to sell for $14. I'm actually going to be selling for $15.03. By initiating the same strike price that you got assigned, whether you're selling covered calls and you get assigned, or you're selling cash secured puts and you get assigned, in reality, you make the profit in between the actual strike price and the cumulative premium collected the entire time. And guess what? If these shares got called away at $14 strike, I could initiate a double wheel strategy that just keeps going perpetual motion where I'm saying I am now doing a cash secured put saying I'm willing to buy the same shares that I just sold for $14 and buy them back at $14 or $13.50 or $13, whatever the strike is. At the same time, I initiated the initial wheel strategy where I had to buy shares at 14, then I sell shares at 14, then I say I'll buy back the same shares at $14. It doesn't seem like a lot, but if you do this over the course of the year, you end up collecting a ton of premium, as I am showing you on this channel. No BS, no fluff, 100% transparency. A lot of people have been asking me about dividend plays. Please click on this link right here. It's a playlist about dividend plays, which I don't make too many videos about that anymore. Or click on this link over here where I'm showing you how I manage underwater plays. Thank you so much, and I'll see you tonight at 6:55 Eastern Time.